Stock buybacks are controversial among investors. Some believe they are a waste of money, while others consider them a perfect way to make tax-advantaged returns for stockholders. Both critics and supporters have good points, but who's right? And before all that, what exactly is a stock buyback, and how does it create value? Make sure to watch until the end of this video because today, we're going to answer all this. Hey, guys, welcome to this channel. Millionaires Club is where financial markets junkies hang out together to learn more about investing and trading stuff. So, if you're new to this community, don't hesitate to subscribe to our channel and smash the bell button. Alright, let's go. What are stock buybacks? Everything you need to know. What is a stock buyback? A stock buyback, aka share repurchase, is when a company rebuys its own stock, lowering the total number of shares outstanding. Buybacks essentially re-slice the pie of profits into smaller pieces, giving more to remaining investors. It's one of the main ways a company can use its cash, including paying off debt, investing in the operations, purchasing another company, and also paying out the money as a dividend to investors. To undertake stock buybacks, companies usually announce a repurchase authorization, which specifies the size of the buybacks, either in terms of the number of shares it can buy, a percentage of its stock, or, most commonly, a dollar amount. A company might use its own cash or even borrow cash to repurchase stock, albeit the latter is usually riskier. A company typically buys back the stock in the public market, just like a regular investor would. So, it's buying from any random investor who wishes to sell the stock rather than specific owners. This way, the company helps treat investors fairly, as any investor could sell into the market. The point is that investors are under no obligation to sell their shares only because the company is repurchasing shares. However, it's significant to know that a company might not repurchase shares at all. The decision to repurchase shares of stock is always made by the management and based on the company's needs. Buybacks could elevate investors' returns considerably, especially when pursued consistently over time. Some shareholders love them as a strategy, and some top executives use them well to meet the needs of their companies. How can share buybacks create value for investors? Number 1. Repurchases return cash to shareholders who wish to exit the investment. Number 2. With a repurchase, the company could raise earnings per share, all else equal. In fact, the same earnings pie cut into fewer pieces is worth a bigger share of the earnings. Number 3. By decreasing the share count, buybacks raise the stock's potential upside for shareholders who wish to remain owners. If the business is worth $1 billion but is split fewer ways, each and every share is worth more. Number 4. They are a more tax-efficient means to return the earnings of the company to shareholders relative to dividends that are taxable to those who receive them. Downsides to a stock buyback. Just because buybacks could be good doesn't mean that they are always good. In fact, they could destroy value as well, and those who hate buybacks also make some good points about why they could be harmful. Here are some of the compelling reasons against buybacks. Number 1. Buybacks could be utilized to cover up stock issuance to managers. If the business issues stock-based compensation to managers, it actually dilutes the ownership of shareholders. Some managers use buybacks to somehow hide how much issuance affects share count. Number 2. Buybacks might let managers enrich themselves at the expense of shareholders. If they have options and the ability to affect the stock price via repurchases, they might decide that they could temporarily increase the stock price to secure a gain on their options. Number 3. Buybacks could simply be poorly done. If a manager is buying a stock at any price rather than at a reasonable price, it might be wasting shareholder capital. For instance, if a stock is only worth $100, but the manager is buying it for $150, that destroys value. Number 4. Buybacks could starve the company of money needed in other areas like research and development or investments into new facilities and products. Thank you for watching this video, guys. If you ever found it helpful, be sure to like it, and don't forget to subscribe to our channel as well. And now, let's see what you're thinking. What do you think about stock buybacks? Do you believe it's a good strategy? You can share your opinions and arguments in the comment section below.